What are the investing mistakes you should avoid? As we set our sights on the future, now is the perfect time to reflect on our financial journey. What went right? And more importantly, what are some of the most common pitfalls that can derail your financial plans? Don't worry, it's not all doom and gloom. We'll also talk about how you can build a strategy that keeps you on track and focused on long-term success. Let's start with one of the most common and costly mistakes: sector rotations. This happens when investors sell out of an underperforming sector or stock and move their money into a hot sector that's getting all of the attention. Here's why this can backfire. Markets move in cycles. What's out of favor today can easily rebound tomorrow, and history is full of examples where investors who jumped ship missed out on massive gains. Take 2022 for instance. Big growth stocks like Apple, Microsoft, Alphabet, and Amazon faced heavy pressure from inflation and valuation concerns. Their combined market cap fell to $6.9 trillion by the end of the year. But fast forward less than 2 years, and those same companies are worth $17.6 trillion. That's a historic rally, and anyone who panic sold missed out entirely. Other examples? Oil and gas stocks sold off heavily during the 2020 downturn, yet the energy sector is up 129% over the past 4 years. Another example are financial stocks. Following the banking crisis of 2023, some investors abandoned the financial sector, but financials ended up outperforming tech that year. So why does this happen? Markets don't reward panic. Sector rotations often occur because investors react emotionally to short-term events without considering the long-term potential of quality companies. But what separates successful investors from the rest is the ability to stay patient and ride out the cycles. The key takeaway from this is, instead of chasing trends, focus on quality companies with strong fundamentals. Over the long term, businesses that consistently grow earnings tend to win out, no matter the short-term noise. Momentum can be exciting. There's nothing like seeing a stock skyrocket and wanting a piece of the action. But here's the thing, jumping into hot stocks without doing your research can lead to trouble. Let's take cryptocurrency as an example. If you're not familiar with how Bitcoin works, buying in just because it's up could leave you exposed to massive volatility. But if you've done your research and believe in the long-term potential, that's a different story entirely. A similar lesson applies to AI-driven stocks. Nvidia, for example, is rising the AI wave and continues to deliver incredible earnings growth while holding off competition. Companies like Salesforce are also monetizing AI effectively, driving their stocks higher. The key is to understand what's driving the momentum. Nvidia's growth is backed by real demand for its GPUs in the AI space, but not every company riding the wave has the fundamentals to sustain it. Some stocks may soar purely on hype, which can lead to painful losses when reality sets in. What are some steps you can take to protect yourself? Do your homework. Before investing in a momentum stock, dig into its financials, market potential, and competitive advantages. Also ask yourself, is this a company I'm willing to hold during periods of volatility? And don't chase without conviction. Only invest if you genuinely believe in the company's long-term story. The key takeaway is, don't dive headfirst into momentum stocks without a clear plan. Instead, research the companies and industries you believe in and be prepared to hold through volatility. Every year brings its share of challenges and surprises. It's so easy to get caught up in the headlines and make emotional decisions, but being reactive to short-term market events can hurt your long-term returns. For example, in 2023, speculations about policy changes under a new administration caused significant volatility in sectors like energy and renewables. While these shifts can impact specific industries, overhauling your portfolio based on guesses about policy isn't a good idea. Instead of reacting to the news, focus on companies with strong fundamentals. Ask yourself, does this company have a competitive edge that will help it thrive, no matter the economic climate? Can it endure industry downturns and emerge stronger? Is the risk already priced into the stock, and am I willing to accept that risk for the potential upside? Here's a good case study. Take Tesla as an example. Despite facing price cuts and macroeconomic uncertainty, its long-term vision for dominating EVs and energy storage keeps it a compelling play. Successful investors stay focused on the big picture, not the short-term noise. The key takeaway here is focus on companies with strong fundamentals that can weather storms and adapt to changing conditions. The goal is to stay proactive, not reactive, when navigating market noise. Let's talk about diversification, one of the most fundamental principles of investing that's often overlooked, especially by new investors. Why is this a problem? Focusing too heavily on a single stock, sector, or asset class can leave your portfolio vulnerable. If that one investment underperforms or collapses, your entire portfolio could take a massive hit. For example, let's say you invested heavily in a hot tech stock during the AI boom of 2023. While many companies like Nvidia thrived, others in the sector didn't perform as well. If all your capital was in one stock, your risk would have been significantly higher. On the other hand, having a diversified portfolio spanning tech, energy, financials, and even international markets reduces risk and helps smooth out returns over time. How do you diversify wisely? The first point is spread across sectors. Invest in multiple industries to avoid overexposure to one area of the market. Number 2 is include different asset classes. Consider mixing in bonds, REITs, or commodities for additional stability. Number 3 is global exposure. Don't forget international stocks. Diversifying geographically can protect against domestic market downturns. Remember, diversification isn't about avoiding losses entirely. It's about minimizing risks and ensuring that no single mistake wipes out your progress. The last mistake I want to address is neglecting to reassess your portfolio. Here's a common misconception, that once you've built your portfolio, you can just sit back and let it grow. While long-term investing does require patience, it doesn't mean you should ignore your portfolio entirely. Markets evolve, companies face new challenges, and your financial goals may change. If you don't reassess your portfolio regularly, you could miss warning signs or opportunities to rebalance for better performance. So what does reassessing mean? It means check your asset allocation. Over time, some investments might grow faster than others, throwing off your diversification. For instance, if your tech stocks have surged, they may now dominate your portfolio. Also, evaluate performance. Identify underperforming stocks or funds and consider whether they align with your strategy. And update your goals. Life changes. Whether it's buying a home, starting a family, or planning for retirement, these changes can impact your investment needs. Your portfolio should reflect these shifts. Here's a quick case study. Let's say you invested in Tesla 5 years ago, when EVs were gaining traction. While Tesla remains a leader, you might now want to rebalance your portfolio with investments in other green energy companies or battery tech innovators to capture broader trends. This may sound contradictory with my point earlier, but reassessing your portfolio doesn't mean overreacting to market swings. It's about staying aligned with your goals, ensuring proper diversification, and keeping your investments optimized for long-term success. Every investor makes mistakes, it's part of the journey, but by reflecting on your decisions, learning from past missteps and planning ahead, you can build a more resilient strategy for the future. The key is to focus on quality companies, stick to your research, and avoid making emotional decisions based on short-term market noise. Diversify your portfolio, reassess your investments regularly, and stay patient through market cycles. Are you looking for 5 stocks with strong fundamentals to kickstart your journey? Then click on the video on screen right now. And here's to a smarter, more successful investing journey. Happy investing!